In financial markets, gravity usually works one way. When a company is accused of being a fraud, the stock goes down. When a company is called a house of cards by major short sellers, the stock collapses. But in the first 3 weeks of 2026, CoreWeave didn't die. It defied physics. Right now, there are two realities. In one version, this is the most important company in America, the oil refinery of the AI age, sitting on a $55 billion backlog that guarantees its future. In the other version, it is a shadow bank, a circular financing scheme designed to prop up Nvidia's revenue numbers. Today, we aren't just looking at a stock chart. We are looking at the engine room of the entire AI bubble. We are going to tear apart the Q3 earnings, the $15 billion debt load, and the specific Microsoft risk that terrified investors last month. By the end of this video, you'll know if this is a generational buy at $94 or a zero. To understand why Wall Street hates and loves this company, you have to go back to 2017. They weren't PhDs from Stanford. They were commodities traders from the NYMEX who realized Ethereum mining was an arbitrage opportunity. They didn't build a cloud to save the world. They built it to mine crypto. And for a while, it worked. Until the crash. When crypto crashed in 2018, most miners went bankrupt. They sold their GPS on eBay for pennies. CoreWeave did something different. They realized that the same cards used for mining could be used for CGI rendering. They pivoted to Hollywood. But the real luck struck in 2022. The world suddenly needed what CoreWeave had been hoarding for 5 years, massive fleets of Nvidia GPUs. While Google and Amazon were trying to build their own chips, CoreWeave went all in on Nvidia. This is the heart of the bear case. Critics argue that CoreWeave isn't really a cloud company. It is a financial vehicle for Nvidia. Nvidia invests in CoreWeave. CoreWeave uses that cash, plus massive loans, to buy Nvidia chips. Nvidia books those sales as revenue. It looks like organic demand. But if the money originated from Nvidia itself, is it really demand, or is it accounting magic? And here is the risk that keeps investors up at night. The debt. CoreWeave has borrowed over $15 billion, but they didn't secure that debt with buildings or land. They secured it with the chips themselves. This works fine as long as the chips are scarce. But if the new Nvidia Rubin chips make these older ones obsolete, the value of the collateral collapses. If the collateral drops, the banks call the loans, and the house of cards falls. However, the bears might be missing the single most important number in the Q3 filings. It's not the debt, it's the backlog. CoreWeave has signed contracts worth $55.6 billion. These aren't handshake deals. These are take-or-pay contracts. That means even if Microsoft or OpenAI decides they don't need the compute, they still have to pay for it. This cash flow is the shield that protects them from the debt. Why would Microsoft sign such a restrictive deal? Because of physics. CoreWeave's network isn't built for hosting websites like Amazon AWS. It is built for one thing: training AI models. Their InfiniBand switching allows thousands of GPUs to talk to each other as if they were one giant brain. For a company like OpenAI, this speed difference isn't just a luxury. It's the difference between releasing GPT-5 in 2026 or 2027. So, where does that leave us at $94 a share? CoreWeave is not a safe stock. It is a leveraged option on the future of artificial intelligence. If you believe AI agents will run the economy in 5 years, this stock is cheap. If you believe the AI bubble is popping, this stock is a zero. Personally, I'm watching the $80 level. If it holds, the bull run continues. But I'm keeping my stop losses tight, because in a casino, the house always wins, but the players sometimes go broke. The infrastructure is being built, the debt has been signed, the chips are in the rack. Now, we just have to wait and see if the world actually shows up to use them. Thanks for watching.